Okay, so over on page 510, we're going to talk about accounting for cash dividends. Now, dividends are where some of the profits of the company have been given back to the stockholders. And what shares get stock dividends or cash dividends? Only the outstanding shares. So you have to know what the outstanding shares are. So there are 3 dates on recording cash dividends. There's the declaration date when the board of directors says that the dividends are going to be paid. There's the record date, which is when they find out who gets it, and then there's the payment date when the money actually goes out. Every time there's an economic transaction, we have to do a journal entry. And so the first time there's an economic transaction is when the company declares the dividend because the board of directors has said we're going to pay a dividend. They've created an obligation. So we have a payable. So what we need to go through and do is to record that account payable or that dividend payable. And so that's what's shown on the bottom of page 511. Now in this case, they go through and they tell you that the company declared a cash dividend of $28,000. The cash hasn't gone out yet. So the dividend, the declaration date, is December 21st. So they just said we're going to pay it. So we've created a dividend payable for sure, because we're going to do that in the future. And the way that we do that is always going to be the number of shares outstanding shares, times the dividend amount. Now they just tell us it's 28,000 here. But on the test, you'll need to know how to calculate that. So it's always going to be the number of outstanding shares. What you also need to do then is, of course, put in a debit. When you give out dividends, dividends are a form of return of the profits to the company. So we show the profits accumulated in the company through the retained earnings. That's what retained earnings are. They're earnings that have been retained in the company. And they're normally a credit account because they're equity. Well, in this case, we're having a debit to that. A debit would reduce an equity account. And that's what this is doing. It's reducing the retained earnings because we're giving some of those earnings we had retained in the company back to the stockholders. So dividends always reduce retained earnings. Now on page 511, you don't see a debit to retained earnings. You see a debit to something called dividends. That's because that's a temporary account. That account is going to be there from December 21st until December 31st, and then this account will be closed into retained earnings. So really, retained earnings is the account that this is all going to go into. So after January 1st, retained earnings is going to have the debit in it. But when you actually post the entry on the declaration day, it's going to be going into an account called dividends as a debit, and then dividends payable as a credit. Then over on 512, you see the next day, which is the record day. That is December 31st. There's no entry necessary there, no journal entry. What happens on that day is they go through and they find out if all the stocks have been bought and sold, who's actually going to receive the shares of stock. And so from that, then they make up the list of who's going to get the check. The next day we have to worry about a journal entry is on January 11th, which is the date of payment. On the date of payment, we're sending money out. So the first thing I always like to think of, well, what happened to cash? Cash went down, so it's credited. So cash is going to go as a credit, and that was to pay off the liability that we have. So that's $28,000 as a credit. And then since we paid the dividend, we no longer owe it because we paid it. We can get rid of that. So the credit and the dividend is going to be recorded with a debit so that they're going to net out. So when it's all said and done, the dividend payable goes away on both sides. And what's left over is the dividend is gone. So by the time we've finished making the declaration and the payment, the effect of this dividend was that cash went down by $28,000 because we gave it to the stockholders, and retained earnings was reduced by $28,000 because we gave some of the profits back to the company. So that's how you record a cash dividend. Okay? On page 513, they talk about something called a stock dividend. Now, a stock dividend is similar to a cash dividend in that we have these dates, but the difference is no cash ever goes out. Instead, what happens is the company just issues more shares of stock and sends it out to people. It makes them feel good. The company doesn't have to spend a lot of money to do that. They print up some more paper. It does cause dilution, but the bottom line is that it does create this sense that the company is providing something to the investors. So we also have to record for these 3 dates for stock dividends, the declaration date, the record date, and it's not a payment date now, it's a distribution date because we're going to send it out. But the way we do it is a little differently because we don't have the cash involved. So what we do is we have to look at the dividend and ask ourselves, well, what's the value of the dividend? Well, the value is going to be based upon whether it's what we call a large stock dividend or a small stock dividend. A large stock dividend is worth where we issue more than 25% of the stock to people. So if you had, Hannah, you had 100 shares, we're going to give you more than 25 new shares, which would make you feel good. But that's going to create a lot of dilution, and because there's more shares out there, that's going to make the price go down. So, well, we wouldn't want to necessarily use the price on that day because that's going to make the price go up and down, or go down based upon the new shares. So you do it before the shares make the price go down, or after the shares go down. It's kind of like the chicken or the egg thing. So what we do on a large stock dividend is we use par value, because par value doesn't change. We're just going to use that. On the other hand, if it's a small stock dividend, so it's a 4%, because that's less than 20%. Small stock dividend is less than 20%. So for Hannah, if she has 100 shares and it's a 4% stock dividend, 4% of her 100 shares, we're going to send her 4 new shares, make her feel good. Now, that doesn't mean her shares are probably going to go down much in value. Maybe a little bit, but not a lot. So if it's a small stock dividend, which we're going to say is, see, small is going to be, make the arrow the right way here. Small is less than 20%. And large is greater than 25%. Let's do it that way. A small stock dividend, we're going to use the fair market value on the date that we do it, fair market value. So these are the two rules we're going to use to figure out how much the value of the stock dividend is. Okay? So that's the first thing when you hear stock dividend, ask yourself, is it large or small? And then if it's large, you're going to use par value. If it's small, you're going to use fair market value. Now, the other thing about stock dividends is that there's no cash involved. As a matter of fact, there's no assets involved, there's no liabilities involved. All we're doing is taking money out of retained earnings and moving it over into the common stock account. It's just a reclassification. So what we're going to do in a stock dividend, if you look over on page 514, in this case, they go through and they tell us that they're going to give a 10% stock dividend. So the first thing we're going to do is we're going to figure out how many shares we're going to give out. Well, we have to know how many shares were outstanding, because stock dividends are issued for the shares that are outstanding. They're the only outstanding shares, the only ones that get any kind of dividend, cash or stock. So we go through and they tell us that we have a total of, on page 513, a total of 15,000 shares issued and outstanding. So I don't have enough room here. We have 15,000 shares outstanding. We're going to have a 10% stock dividend. So that means we're going to have 1,500 new shares. So now we got to figure out what's the value. Well, since it's a 10%, that's going to be considered a small stock. And so we're going to take these times the fair market value to find out what the value is. The fair market value on the date that this is declared, they tell us on 514, was $20 a share, right? Make sure I got it right. Nope, that doesn't look right. What was the value? No, it was $20 a share. So it's $20 a share. So we take $20 a share times a 15. That means we're issuing $30,000 worth of new stock. Well, whenever we do a stock dividend, we go through, again, on the date of declaration, which in this case was February 24th. We go into dividends, only now we're going to call it stock dividends. And we just figured out that's $30,000 because we're taking it times the fair market value because it's a small stock dividend. And we found out it was 1,500 shares, so we took 10% of the outstanding shares before the stock dividend. When we issue the shares, we're going to go through and we're going to issue new stock, so we have to put it into common stock. So what we're going to do is we're going to put it into common stock. They call it common stock distributable. But the common stock is going to go in, and it's going to be multiplied times the par value, which is, what is the par value? $5. So it's the 1,500 shares times $5. So that's going to go in as the $7,500. And then the difference is going to go into the additional paid-in capital. So that's going to be $22,500. Yeah. So we have a similar transaction on the date of declaration, only there's no payable because we're not going to give any money. Instead, we have an obligation to at some point in the future distribute the stock. Then we go through and we have the payment, we have the record date on March 15th. Again, there's no entry. We just keep a list of who's going to get it. And then finally, on, they call it payment date, it's really distribution date, on March 31st, we actually send the shares out. Well, when that happens, we take the shares that have been sent out, they've been sitting in this common stock distributable account for a while, that's a temporary account, that's going to go away. And now we're going to go through, it's going to be $7,500. Now we're going to go through and put the other amount into common stock because at this point the stock's been issued and now it's outstanding and it can vote and receive future dividends and everything else just like any other outstanding shares. So that would be the entry that we would go through to do to move the stock. No cash has been involved, no assets or liabilities were affected. All happened was we moved stock out of one account into two accounts. Now, just like we talked about on the cash dividend, this gets closed out at the end of the month. This is going to get closed out. Stock dividends will be closed out to retained earnings. So the effect of a stock dividend is to simply take money out of your retained earnings pocket at whatever the price is, whether it's a price or if it's a small stock, a fair market value, or if it's a large stock at a large stock dividend at the par value, and then to move it over and put it into your common stock account pocket and split it between common stock and additional paid-in capital. You have the same amount afterwards in your equity. Your total stockholders' equity didn't change. You just moved it from one piece into one other or two other pieces. Okay? So that's the stock dividend. You don't use them a lot, to be honest, but companies do have these on occasion when they want to do a non-taxable distribution, like to spin off part of their company. So you'll see every now and then, several times during the year, big companies will do a stock dividend. It's not completely unusual, but it's not that common. A more common way of doing things is the stock split on 513. A stock split is where you go through and you split the price of the stock. So you do a 2-for-1, kind of like a 2 for Tuesday, where you go in and you get 2 meals or 2 drinks for the price of 1. Same thing on a stock. You can do a 2-for-1, 3-for-1, 4-for-1 split. So if we do a 2-for-1 split, for example, then Tyler has 100 shares of a company. Now he gets sent another 100 shares. Now you have 200 shares. That brings the price down. Because if it was worth $1,000 before when you had 100 shares, now what happens is you have 200 shares that are probably going to be worth $1,000, but now the price, instead of being $10 a piece, is going to be $5 a piece. So your total value is the same, it's just spread out over more shares. This is used to bring the stock price down. It's easier because there's no journal entry. So there's no debits or credits. Nothing happens on there. So that's why people like it. You don't have to do all this stuff. But there are two things you need to keep in mind. If you have a stock split, it's going to split the par value in half. So if you started off with a par value of, what do we have here? $5, your par value is going to go to $250. But more importantly, the number of shares outstanding are going to change. So if you had 100 shares that were outstanding before a stock split, and you did a 2-for-1 stock split, now you have 200,000 shares outstanding. And that's important because, again, outstanding shares are the ones that vote, they get paid dividends in the future and that sort of thing. So when you have a stock split, you don't have to do any debits or credits, no numbers are involved. Just make sure that you keep in mind that you have to adjust your number of shares outstanding. Okay? Now that all leads us over to page 517, which is the big thing, the statement of stockholders' equity. That's a great way to go through and put all this stuff together, but it's kind of a little bit scary because it's got all those numbers on it. But all the statement of stockholders' equity is doing is trying to go through and show how your equity in your company from last year, the end of last year, got to where it is at the end of this year. Because balance sheets just show you where you were last year on that date, snapshot, where you are this year on the end of this year on that date, snapshot, and you don't see how you got there. Change. So the statement of stockholders' equity is more like a motion picture trying to show you how you got there during the year by showing the transactions. So if you look on page 517, you're going to see the statement of stockholders' equity. And this is something that you'll be doing on the test. So the first thing you need to do is don't panic. Take a deep breath. Because a lot of the information you're going to be needed is going to be given to you to get started. The first thing is the statement is always going to start with, you're always going to have a heading, so you want to put a heading up here, the name of the company and everything. But then the columns that you have are basically the balance sheet. If you look on the bottom of 517, you see a balance sheet there where it starts with preferred stock, common stock, and goes down. Well, if you take that balance sheet and you kind of tip it up like this, those are the columns going across. Because you'll notice the columns across the top are first preferred stock, common stock, additional paid in capital, retained earnings, and treasury stock. So that's just basically where we're showing where we started at the beginning of the year. Now the order is important because if you have preferred stock, it always goes first. And I will be picky. I will want you to put them in the order they would appear. So if there's preferred stock, it has to be in the first column. Then what you would have is common stock. You'll almost always have additional paid in capital, PIC. Then you'll have retained earnings. Showing I don't have my good whiteboard management skills here. And then finally, you'll usually have treasury stock. And then you're going to have a total out to the side here. Okay. So you'll have to go through and get that set up. But then what happens is you start with the beginning balance. This is just the balance at the end of last year. So this is the balance. In this case, last year was 2014 because they're doing it as of 2015. So balance 2014. Now I'm going to give you this number. That balance sheet that's on the bottom of 517, I'm going to give you a balance sheet, but I'm going to give you the beginning balance sheet. So all you'll need to do is just go to that beginning balance sheet and write these numbers across. So in this case, they gave you the ending number, but on the homework assignment I gave you, I think they gave you the beginning number. So the balance sheet at the end of last year showed that you had $800,000 in preferred stock, you had $600,000 in common, you had $600,000 in additional paid in capital, you had retained earnings of $1.2 million, and you had nothing in treasury stock because that hadn't happened yet. Wait a minute. And then so you had a total of $3,200,000 in equity. That's right off your balance sheet. That's given to you. You just need to know to take the balance sheet that's reading like this and tip it up and fill in the headings. Now, columns are important. If you don't have preferred stock, you don't need to put it in there. If you didn't start with preferred stock, but you added it during the year and say, oh, I'll just put it at the end, I'll ding you for a point because the preferred stock, even if it didn't happen at the beginning of the year, but it got added during the year, has to be the first column. That's a GAAP requirement, so it's in the order of the equity section. And then all you do is you just go through and look at the transactions in the order that they occurred. So, for example, your net income, they tell you, they have to tell you what happened. They tell you that net income happened, and it was $540,000. Well, net income increases your retained earnings. So you just come over here and add a positive $540,000, and of course, carry that across to the total. Now, one thing about this schedule, this is not a ledger. You don't have to have two entries. This isn't double entry bookkeeping here. There's no debits or credits up here. This is just showing the amounts that show changes, increases or decreases in any of these equity accounts. So in this particular case, retained earnings went up because we had a profit. It's shown as a positive. These are all equity. If it increases equity, it's a positive number. If it decreases equity, it's a negative. So a net loss increases it if we had a net net income increases it. If we had a net loss, we do what? Subtract it, right? So then we go through and it shows that we issued new stock. So we issued stock. Well, this is just like that entry we did earlier where we're issuing stock. They go through and tell us that we issued 10,000 shares of stock, and if you read the details, and I will give you the details on these transactions, you sold it for $10 a piece. Oops, sorry, you sold it for $50 a piece because you got $500,000. It's a $10 par value, so if you have 10,000 shares times $10 par value, I have to do an entry where I put 100,000 into my common stock. I got $500,000 in total. If I have 100 in here, the difference went into my additional paid in capital, so I have 400,000 here, and then the total of those two is my 500,000. Now that's not cash. This is just the two entries of the one side of the journal entry. I don't worry about the cash side because cash is an asset, and assets aren't up here. I only care about the accounts that are equity. So again, don't try to do the debits and credits. They're not debits and credits here. So That's all I have to have. These are all going to be zero amounts because there's nothing for those. So that's an increase. So that shows me that my equity went up, my stock went up, and my capital went up because I issued stock. They have an example here where you converted some preferred stock. You're not going to have to worry about that. So I'm just going to go through and put it in here. Don't worry about converted stock. Converted preferred stock. All they're doing is saying that you got rid of some preferred stock. So you show that as a negative. You got $200,000 worth of stock. You talked people into taking your common stock. And so since you swapped stock for stock, it didn't have a big impact on your total equity, so nothing changed. You just increased one and decreased the other. The 10% stock dividend, that is one you need to kind of know, because on the 10% stock dividend, you need to go through and see how much you had in your dividend. In this particular case, it's a small stock dividend, so they tell you that the amount that you ended up paying was $380,000. Well, that's going to come out of retained earnings because you're taking that money out of your retained earnings pocket. And then you issued 7,600 new shares, $10 par value, $10 times 7,600, that's $76,000 going in here for your common stock. So common stock went up. The difference you need to balance for your equity is $304,000. So that's your stock dividend. And again, your stock dividend didn't have an impact on your total equity because you just took it out of your retained earnings and then you put it into these two accounts. And then you put it in here at the par value times the number of shares, just like you did for any other stock or cash dividend. You purchase some Treasury shares. They tell you that you purchased $48,000 of Treasury shares. So you purchase Treasury. Well, when you buy Treasury shares, cash goes away, but we don't show cash up here because it's not an equity account. But what we did do was we reduced our equity. Because remember, we debit Treasury stock when we do that entry. So the debit is going to be not shown on here as a debit. It's going to be shown as a negative number. What was it, 48,000? Because it reduces our total stockholders' equity. So we have to show it as a negative number. If you don't show that as a negative number on the test, I'll count off a point because it has to be that it's shown that it's reducing the equity. So now you've gotten all the way through this, and you're going, okay, I did all this stuff. And the very last thing you have are where you calculate your cash dividends, okay? Now, this is where it's a little tricky because you've got to go through and figure out how you came up with the dividend amount. I'm not going to worry about the preferred stock. I'm just going to put it in there. I'm going to talk more about the common. So we had a dividends, preferred. They just tell you it's 48,000, so just 48,000? Yeah, it's the same amount as the Treasury stock, isn't it? But remember, dividends reduce retained earnings because you're giving back some of the retained earnings in the form of dividends, whether they're stock dividends or cash dividends, it doesn't matter. So that's shown as a negative number. What I want you to focus on is the common stock dividends, because that's something you'll probably have to do on the test. And what you need to do, what people forget to do here is they go, okay, so the common stock dividend, they tell you how much per share it is. I don't know if they give you that calculation or not, but on the exam, and I know on the homework I gave you, it'll be similar on the exam, I went through and calculated up what the dividend would be per share. Well, what happens with that is that you go through and you have to keep a running total of the number of shares that have been issued and outstanding. So you start with however many shares you had at the beginning of the year, and you take that number and you have to add in all the transactions that happened. So you got to go back through the transactions for the year. So I issued some new shares. Well, how many shares did I issue? I think it said that I issued 10,000 shares. So I've got to add these 10,000 shares back to what I started with to keep my running total of my outstanding shares. It said I converted some preferred stock to common, so I'd have to add that in because I have new common shares, 6,000 shares. I had this stock dividend I issued. It got distributed out there, so that was another 7,600 shares. I've got to add those in. The Treasury shares don't get dividends, so I have to subtract them out of my running total. If I have a stock split going on, I need to keep that in mind because the stock split is going to double or change the number of shares by whatever type of split it is. So when I get ready to do my dividend down here and multiply it by my 20 cents or whatever it is, I need to go through and keep this little running total of what my outstanding shares have done so I have a number to multiply it by. Now, they don't have it in this example in the book, but in the homework problem I gave you, you had to go through and keep a running total. So hopefully you were able to do that. So in this case, a common stock works out to be $95,200. And again, it comes out of retained earnings as a negative, so it's dividends, common. Now, if everything works and I go through and I add all these up, and I'm not going to do it here because I'm running out of room, I add these up and add these across, they're going to agree with this number that comes down here. This number is going to be my ending number on my balance sheet for stockholders' equity. So I have a check figure. This number should agree with what I had at the end of the year. It's a lot of numbers, isn't it? So that's the statement of stockholders' equity. And I like using that because I think it's a good way of going through and summarizing everything that happens when we issue stock or treasury stock or pay dividends or any of the other calculations we've been doing. The last thing in Chapter 13 we're going to look at is the book value over on page 518. And the book value is where we're trying to go through and find out what the value of the company is if we were to liquidate it. So what we're going to do is we're going to look at the equity and try to figure out how much of that equity would go to each stockholder if we were to suddenly just decide to sell the company off, pay off all the debts, take everything we convert it into cash and give the cash to the stockholders. It's not going to happen, but it gives us an idea of seeing how much a company might be worth. So the book value formula is pretty simple. Book value is going to equal the stockholders' equity divided by the number of shares outstanding. And don't forget, stockholders' equity is just your assets minus your liabilities. So if we took all the assets and sold them for cash, paid off all the liabilities with the cash that would be left over, stockholders' equity, would then be divided by the number of shares outstanding, and that would be the amount that's going to go out to each of the stockholders. Now, if we have just common stock, this is a simple calculation. It gets tricky when we have preferred stockholders because the preferred stockholders get paid first. So what we have to do is figure out how much money would go to the preferred stockholders first and pretend we're going to pay them off. Then what's left over is what we use for our common book value. And that's what they're showing on page 518, where they go through and they calculate up where they have to pay off the equity allocated preferred stockholders. There's 6,000 shares of preferred stock. We have to pay them before we can give anything to the common stockholders. We have to give them $105 because that's their callable value that we've said if we buy it out that we're going to give them a premium. So $630,000 of this money has to go to the preferred stockholders. Plus, in the example down below where we had some dividends and arrears on 518, we actually owed them another $48,000 for dividends we hadn't paid. Well, we have to pay them first before we pay anything to the common stockholders. So it ends up that $678,000 would need to go to pay off the preferred stockholders. Now, none of this is going to happen. We're not really liquidating. We're not really paying everybody this money. But we're pretending it did. Who would get it if we did do it? So the $678 is what we have to take and set aside and give to the preferred stockholders. So the $678 gets subtracted from the total equity to then come up with a common stockholders' equity. So if you have preferred stock, you got to take total stockholders' equity and then subtract the preferred stock equity if you want to try to find the common book value, common stock book value. Okay? So that's book value, and that's on 518. That'd be something you probably need to know. Okay? I think that wraps up Chapter 13 for us.